Hey traders, welcome back again. London session. It's about 10:44 GMT. I'm going to go live with my members in my academy in an hour. Don't forget, if you want to learn to trade, underneath is my free training. I put loads in there. So today, well, you can see the dollar strength that's flowing into the market is pulling down gold. Now, this typically is known as a risk-off environment as the market is sort of calmed down and soured after Thursday, and there's a bit of a wait for further announcements and talk by the Fed. You did get some comments that did a little bit for markets yesterday, and they dropped the S&P, okay, and it's also dropped gold. Now, really interestingly, and I've said this in loads of my videos, it's something you have to understand. Gold has more or less unpegged itself in terms of sentiment. What drove gold before mostly was panic. When people were scared, most people know quite easily they'll buy gold. It's a risk-off environment. People take risk off, in other words, put simply. But it's completely changed now. On dollar strength, when people are plugging their money into safe assets, you're getting a pull down in gold, which is the inverse of what used to happen. So trading gold already is more difficult because of that mismatch in sentiment, or that change in sentiment driver. Now, I did quite a few videos on this, quite a few drawn analysis, and I said it a few times just to warn everyone in case it caused a problem. I said, look, if you're going to sell everything you have and you're going to pretend the market can't go a bit higher, it could hurt. If you were someone who placed a stop just above here, you would have been closed out. Typically, this is known as a market maker stop. And it's where you get larger flows, larger bodies, or professional traders. I had some of my members short it very lightly. We said very lightly. We said it's still a short, but just very light. And you also would have had institutions who saw this and said, "Wow, this is the highest price ever. We're slightly above the previous high. We're going to load in short." And it's rebounded quite well, to be honest, off the back of a surge that started on the 27th of June, all the way through to the 17th. Okay, so 3 weeks or so of up move, you can see that souring, and now as the dollar strength comes in, it's pulling down gold. Okay, it's gold against the US dollar anyway, so that's what you might expect from a very simple perspective, but from a historic one, definitely a risk-on asset wouldn't do this normally. And you wouldn't find gold dropping with the stock market. You would find the stock market dropping and then money going into gold as a safer option, because there's more ambiguity, there's more uncertainty around what gold is going to, what the stock market's going to do, how stocks are going to perform in economic headwinds versus gold, because gold traditionally has gone up over and over again for a long period of time. So coming down now, I should think there's going to be a lot of traders who are thinking, okay, well, where should I exit and where should I buy? Now, I mentioned yesterday on my S&P analysis that you would need the market sentiment really to continue for these moves to fall. So you would need the continuation of dollar strength, S&P weakness, and obviously, therefore, you would have gold come down. And you would need something shocking. I think at this point, you don't have that. I think the market is just correcting slightly. I don't think you can say now, okay, well, gold is just going to absolutely tumble because the market sentiment has completely changed. That hasn't come across the wires. In many instances, or at least for the long-term period, you can see November 22, you've just come all the way up. And it's just the same for the S&P from about October 22. You could count it from the same area. Gold and the S&P have risen in tandem, because every time you've had a fall, there is just a rebound of positive data, positive rhetoric out the Fed, more mentions of a soft landing, much more of a safer environment, or one that's likely to stimulate economic activity and get things back to normal. So it removes the worries, essentially. Typically, again, if you had that, if you look at places like after the financial crisis, for example, you would have money start to be pulled out. As we came out of the financial crisis, people sold gold because it became a risk-on market where they wanted to invest and they wanted to take on risk. It was the same after COVID. But now you've got a point where that's completely unpegged and people are buying gold over the long term in a risk-on market, essentially. So if you want to buy it, for me, it just hasn't come back far enough yet. I mean, if you look at 2480 or so where it peaked, 2484 was it, 83, it's only come back less than $70. It's not a long way. If you look at the long-term market from where we said 2022, I mean, if you did this as a retracement of the whole move, I mean, you can hardly even be serious. That's like 5%. Okay, 5%. If you had a massive market correction now, then you would expect to come at least to this moving average here. So I would say if you do get down there, what you're going to end up with is not only a reasonable price for entry based on value, okay, reaching higher long-term MAs, and you'd probably see your 20 and 40 start to drift to the downside as well to meet with that. That is where really you would only start to get a good chance of having a reasonable profit margin. Because if you buy now, I mean, you've only got that much room until where you just fell from and you just saw people selling from. So don't jump in. You know, the people who lose money typically would say, oh, wow, gold is falling. I'm going to buy because I need to do it now. If it becomes a case that you do end up with that rhetoric change, you do end up with that massive sentiment change and gold gets slammed, okay, you'll just get ruined. And there's no point in taking that risk. So I really wouldn't consider getting long unless it comes down here. Now, on the flip side, it's just the same as I mentioned. You know, if you're someone who's going to sell it back at highs and pretend it can't go any higher, like you probably did last time, or the time before, or indeed along here and throughout history, okay, you know, again, it is fine as a short. And that's why I mentioned to my traders in the academy, if you're going to sell it lightly, because now they can still exit for gains. If they sold it heavily, they wouldn't have been able to do that. They would have been up, and they would have been out all the way up there, and then it would have fell against them if the size was too large. So that's why we trade so small. But, you know, if you want to reshort it at highs, I mean, you've got the case for it, don't get me wrong, but it's just going to have to be light because you know, as I say, you can't pretend that strong soft landing sentiment that's driven up the S&P and will drive up gold won't continue. And it looks that way. I mean, it looks like that based on the continued news that's come out, the continued sentiment, the continued rhetoric, which supports that case for for easing by the Fed, essentially a weaker dollar, and therefore you know, you're getting the flip side on gold and the S&P and things like that because there's a stronger outlook on the economy if rates are coming down. And that's causing people to invest in gold, which is not typically what used to happen. So, as I say, light shorts at the top, and I wouldn't buy until you get much lower. That is my bias really on gold. In any case, I would just trade it small. Gold can be a bit risky, and the pit value is obviously different compared to other assets. So just make sure in your portfolio you understand that because something else you'll trade will have a different pit calculation as price moves. Because remember, this is $2,416 and it's measured in ounces. Whereas if you look at the euro dollar, it's $1 for €1, you know, or €1 for $1.09 or something like that. It's completely different. So bear that in mind. Thanks for watching, guys. You can learn underneath how to trade for income like me and my co-founder, who's a veteran trader. I'll see you in the next one. See you there.